My name is Dayan Warsi. I'm an associate at Lexygen. Welcome to today's video, where we'll dive into the world of alternative investment funds, or AIFs in India. This video is meant to be educative in nature and aims to accustom you to alternative investment funds as pooled vehicles, type of alternative investment funds in India, and gift city funds. So, what is an AIF? An alternative investment fund, or AIF, is a privately pooled investment vehicle that collects funds from sophisticated investors, both Indian and foreign, and invests according to a defined investment policy. Currently, AIFs are regulated by the Securities and Exchange Board of India, or SEBI, under the SEBI Alternative Investment Fund Regulations of 2012. Primarily, there are three types of AIFs in India: Category 1, Category 2, and Category 3. While some features are common across categories, like raising of funds through private placement by issue of placement memorandum to investors, requirements for managers to have a continuing interest in the fund, and the need for approval of 75% of the investors by value of a fund to make investments, etc. There are some differences too. Let us deep dive into the categories to understand the different types of AIFs in India. Category 1 are generally close-ended and have a minimum tenure of 3 years. This category includes AIFs that invest in startups, or early-stage ventures, or social ventures, or SMEs, or infrastructure, or other sectors where the government or other regulators consider it socially and economically desirable. Category 1 includes venture capital funds. These funds invest in startups with high growth prospects. HNIs investing in VCF adopt a high-risk, high-return strategy while allocating their resources. Angel funds. These invest in budding startups and are called angel investors. They bring in early business management experience with them. These funds invest in those startups that do not receive funding from VCFs. The minimum investment by each angel investor is Rs 25 lakhs. Infrastructure funds. These funds typically invest in infrastructure companies like railway construction or port construction companies. Social venture funds. These funds invest in socially responsible businesses. You may consider the investment by these funds as philanthropic investments that have a scope of generating decent returns for the investors. Each scheme of the social impact fund shall have a corpus of at least 5 crore rupees. Category 2 is a residual category in the sense that any AIFs that do not fall in Category 1 and Category 3 and which do not undertake leverage or borrowing other than to meet day-to-day operational requirements are included in this. This category includes private equity funds or debt funds for which no specific incentives or concessions are given by the government or any other regulator. This category includes private equity funds that invest in unlisted private companies. Usually these funds have a life of 4 to 7 years. Debt funds that invest in debt securities of unlisted companies. As per SEBI guidelines, money accumulated by debt funds cannot be used to give loans. Fund of funds. Such funds invest in other alternative investment funds. They do not have an investment portfolio but focus on investing in different AIFs. Category 3 includes AIFs that employ diverse or complex trading strategies and may employ leverage, including through investment in listed or unlisted derivatives. Examples of Category 3 includes private investment in public equity fund, PIPE. A PIPE invests in shares of publicly traded companies. They acquire shares at a discounted price. Investment through PIPE is more convenient than going for a secondary issue owing to less paperwork and administration. Hedge funds. These funds pool money from accredited investors and institutions. These funds invest in both domestic and international debt and equity markets. They adopt an aggressive investment strategy to generate returns for investors. However, hedge funds are expensive as fund managers can charge an asset management fee of 2% or more. They can also levy 20% of the returns generated as their fees. Funds in Gift City. In 2015, Gujarat International Finance Tech City, Gift City, was inaugurated under the vision of Prime Minister Narendra Modi as India's first and only operational international financial services center, IFSC. It offers unparalleled ease of doing business through a regulatory framework comparable to global financial hubs like Dubai and Singapore. Funds can operate in GIFT City under favorable conditions, enabling diversification of investment strategies. The ecosystem is further strengthened by flexible fund structures and exemptions from several restrictive norms otherwise applicable to AIFs outside the AIFs, making GIFT City an attractive hub for establishing and managing funds. Funds in GIFT City are governed by International Financial Services Center Authority (IFSC) regulations 2022. Unlike domestic AIFs that are regulated by SEBI, these funds benefit from greater operational flexibility. The key advantages for funds in GIFT City include tax benefits, a 100% tax holiday for 10 consecutive years within the first 15 years, FEMA benefits, non-resident status for the purposes of FEMA, and currency flexibility. IFSC-based funds can use any global currency for overseas investments, facilitating smoother fund transfers. So, that's a quick overview of alternative investment funds in India, including the opportunities in GIFT City. If you have any questions, feel free to leave a comment below or contact us at lexygen.law.